Good evening, everyone. Hope you're doing well. Thank you so much for joining us for Financing Capital Projects. My name is Elise Rosemarin, and I'm a Senior Vice President here at AKAM. Joining with me this evening, I've got Reginald, Breton, Matt Resnick, and Matt Cebula, all of whom work for AKAM. So thank you, gentlemen, for joining us tonight. I'm just going to give you a brief background of everyone who is our speaker this evening. And I just want to let you know, so this is going to be a roundtable format. And at the end, we, of course, invite you to ask any questions that you have. Please feel free to filter your questions through the Q&A. And if there's anything that you forget to ask during this presentation, we're happy to answer any questions that you might have lingering. And feel free to reach out to any one of us. So thank you so much. All right, let's get started. So Reginald Breton is a cash management specialist here at AKAM. He brings to his position over 25 years of banking experience, including 12 years of commercial lending, where he had bid over $100 million in condominium restoration projects. Thank you so much, Reggie, for joining us.
Thank you.
Matt Cebula is a director here at AKAM and has been with our company for many years. He oversees an array of ancillary services available to AKAM's client base, including commercial loans and refinancing. Matt has assisted multiple properties in the lending process, including both co-ops and condominiums, ensuring that each transaction is handled properly from initiation to closing. Welcome, Matt, and thank you. And last but certainly not least, we've got Matt Resnick. Matt is a director of project management here at AKAM. Matt and his team are experienced project managers and bring their distinct expertise to each job, ensuring all project needs are assessed and that proper procedures are followed from conception to completion. Welcome, Matt, and welcome all. So let's get started. So I'll just give a brief overview about what we're going to be discussing tonight, and then I'll kick it off over to Matt Resnick, who will continue. So thank you. All right, so tonight we're going to be discussing identifying capital project details, options for paying your capital projects, navigating the bank loan process, insights and best practices, and then again, the Q&A at the end. And of course, if there are any questions that you have throughout, please put them in the Q&A box and we'll be happy to get to them as soon as possible. All right, Matt, let's get started.
All right, and thank you. So when determining, how to finance a project, the first question is, how much is this going to cost? And it's not just construction. There are DOB fees, there are engineering fees. You need to pay an attorney to draft a contract and even sometimes access agreements. We need to make sure there's a robust contingency. So the first thing we do for the project, you're thinking about financing is, what is it actually going to cost in a worst case scenario to complete this project? And then also, the city has cyclical laws, local laws, right, for compliance. We have local law 11, now known as FISP, for facade inspections, and therefore work that comes from it every 5 years. We now have local law 87, which affects buildings every 10 years, which is energy related. And then a more robust energy law, local law 97, actually requires buildings to reduce greenhouse gas emissions by a certain percentage or face fines in 2025 and 2030. So sometimes it's not just about the project you're thinking about, but we want to have a good plan on what projects might be in the pipeline, what are in the pipeline, and then based on that, understand what your funding needs are going to be for the duration of a proposed loan. And then really, before we even start thinking about loans, the first thing we want to do is have an attorney, your building's attorney, check the bylaws, see if there are any threshold amounts that require owner approval, or if there's a carve out to say certain mandatory projects, such as a facade project, actually don't require that owner vote, and then you can proceed accordingly.
Great, thank you, Matt. All right, so what are some options for paying for your capital projects?
So typical ones that most buildings have thought of in the past are obviously, assessments. Some buildings can actually finance projects via flip tax and transfer fees, should they be sufficient. But more recently, we've been focused on decreasing the price of projects via state and municipality incentives. And then there are other types of loans, such as from NYSERDA, the state, energy-related ones. Con Edison will actually provide rebates for certain projects so that they don't have to upgrade their infrastructure. And then PACE grants, which are basically allow you to finance a project over your New York State real estate taxes. And then finally, there are bank loans. So once we've determined that a bank loan is necessary, at that point, we would work with either Reginald or Matt Cebula on what the appropriate loan is, let them know what the principal we're thinking of is for that loan, and really let them run with that process from there.
Great. And then as far as navigating the bank loan process, it seems like, assessments, all these are different options, but are there recommendations that you make for particular capital projects? Are there certain nuances that you say, different loan might offer? Reginald?
Sure, of course. The most important thing, first of all, when you're starting, is you need to get you need to have multiple bids, typically at least 3 bids for the association. Before you get the bids, you have to have some sort of a summary of the project. If you can get a summary which helps detail the general cost, it's at that point that you can present the summary project with your financials to the bank so they can overview and look at presenting you with a term sheet. And the term sheet, it's you can say it's like the closest thing to a sort of a pre-qualification that you can find. It's not an actual loan approval, but it's a general summary that banks offer. And they review the financials of the association. They review the delinquency ratios, they review the financial strength, and they look to see that if this loan falls within the guidelines of their lending criteria for lending to an association. If it does, at that point, they will issue a term sheet outlining general terms that they would like the association to consider. And if the association finds the terms agreeable, when they're ready, they then accept the terms. And it's at that point that once the association decides which bank to use, the loan can then go into full underwriting process. But typically, you want to see at least 3 bids for each loan for an association.
Got it. Are there specifics that, as far as AKAM in helping our clients navigate the loan process, what are the things that you would help, I guess, in this process as far as navigating is concerned?
I mean, obviously, the first thing that everybody asks is what's the rate of the loan and how much is it going to cost us. But there are other things which are equally as important, sometimes more important than just the rate. First and foremost, you want to find out the structure of the loan. How long is the capital improvement project going to take? Loans are typically structured that the first 12, 18, 24 months, it's a non-revolving line of credit. That line is drawn upon during that time frame in order to complete the entire scope of the capital project. Once the project is completed, at that point, the loan then terms out over an amortization period. It can be 2 years, 4 years, 8 years, 10 years, 15 years. So you want to see, with the bank, what's their appetite? If it's a larger loan, typically you want to extend the amortization period for a greater period. That way, it minimizes the monthly outlay for the association members. You also want to look at the commitment fees. Commitment fees for the bank, they can vary, and they can be pretty substantial. Sometimes it's not uncommon to see commitment fees of 1% of the loan amount. And when you're looking at a loan amount of, say $2 million, well, 1% can be pretty significant. So you want to focus on the legal fees, and you also want to see what the prepayment penalties are as well too. A lot of banks like to offer prepayment penalties. Sometimes it can be a prepayment penalty of 5% the first year, 3%, 4% the second year, 3%, then 2%, then 1% over the first 5 years of the loan. Some banks, some banks like to offer 1% penalty. That tends to be more of the norm. So prepayment penalties are extremely important because if it comes time to pay it off, prepayment penalties can be pretty significant. And also banks require a depository relationship for the loans. And you have to be very careful. Some banks want all the funds of the association at the bank in order to consider the loan. Other banks are more flexible, where they only require maybe a certain amount of reserves on deposit. So again, just don't focus on the rate. There are other aspects that are all outlined in the term sheet to really weigh which loan is the most advantageous.
So actually, that's interesting because I know that sometimes different boards they'll have reservations about asking for too much money. If they're they're trying to think about their overall spend, they might be fearful of, getting a loan for, say, they think it might cost $2 million, but maybe it might be 3 million. They might be afraid to ask for 3 million because of the pre-penalty. So can you kind of maybe discuss on your perception of how you would work with the board in that way?
Sure. I mean, obviously you want to have as much money as possible in order to take care of the loan, but banks are not going to loan any extra money that is not necessary for the project, which is why, of course, you want to have your engineering bids lined up so that you can have a good idea of what the project is going to cost. So if you're, looking at a $2 million project, the banks are just going to offer $2.5 or $3 million. They're going to keep it in line with exactly what the scope of the project is.
Yeah, and you should always try to plan to ask for a little bit more than you actually need to build yourself a little bit of a cushion, because it's always easier to ask for a little bit more, go through the application process and the underwriting, and then reduce the loan amount by a few $100,000, then go back to the bank and try to get more money from that, from the lender, because that can basically put you back at the starting point where, the loan was underwritten and approved for a certain amount of money. And now that you're going to be asking for more, the credit committee at the bank might say, all right, you have to go through that whole process again now that you're asking for more. Obviously, if you're asking for less, you've already been approved for a certain amount that's above that threshold. The other thing that, you have to consider when, going through the loan process is the timing of the loan. So let's say, you have a facade project. That project will be starting, in 6 months. You have to realize that the loan process itself in today's world, I would say it takes between 90 to 120 days. And that's with pretty much any lender who, with the interest rates where they are today, is inundated with offers, and, their underwriting teams are stretched to the brink. In the midst of all of it, we have base loans and the PPP loans. The same underwriting teams that are underwriting your, capital improvement loans had to go through the 2 rounds of PPP loans. So the lenders are really stretched, and the process is, like I said, 90 to 120 days. So you can't expect to start a project and obtain the financing within a month to 2 months. It's really has to be, a well-planned process that the board is working on with all, parties involved, whether it's management, your engineer, your project manager, as well as, your financial advisor at AKAM.
And even your contractor, right? Being upfront about how you're going to pay for the project is always useful. Perhaps you do a smaller percentage deposited and larger payments during the course of the project, and just being upfront and transparent, although it seems counterintuitive, actually tends to help.
And to what Matt Cebula mentioned just before Matt had spoken, is a lot of times a bank will offer a very, very good rate. But as Matt said, that rate might be only good if the loan closes within 30 days, or a very limited time frame. And not to disparage any prospective lender, but if it's a very good rate that is not, if the loan is not going to close in a certain amount of time, the rate tends to be somewhat meaningless, which is why I don't just focus on the rate. You really have to look at the whole entire the term sheet of the offer in hand, so you can make the best decision. Sometimes slightly higher rate, but that is guaranteed for a longer period of 60 to 90 days is most likely the better way to go.
And also, what does this mean? What does this mean for operating costs, right? Money's not free, unfortunately. And it might affect your monthly and annual payments. What effect will that have on your building's overall budget for the year and years to come? And so we like to factor those in before, we recommend, signing anything and moving forward, because at that juncture, when you realize sometimes what the monthly payment changes and the percentage increase to common charges or maintenance, we might change the principal or even some of the ways in which we're going to fund the loan.
Exactly. And any lender will want to know, what is your plan for servicing the debt that you're planning to take on, whether it's, increasing common charges, instituting an assessment that's, dedicated to paying the loan off. So all of those things have to be, well thought of and prepared in advance of even, going through the underwriting with the lender.
So are all, and I believe this is, I know the answer, but are condos and co-ops, are they able to get the same type of loans, or are there nuances even with applications for capital improvement projects?
So Reggie, maybe you'll take the condo question and I'll handle the co-op.
No one can hear you, unfortunately. And I'm sure you have a lot of words of wisdom.
Again, with the condo loan, they're all going to be pretty much structured the same way. Your first 6, 12, 18, 24 months, it's going to be a non-revolving credit line that you can draw upon. And you can multiple draws. And if you finish, once the project is done and complete, then the outstanding balance at that point is then converted to a term of, say, 2 years, 4 years, 8 years, 10 years. It's amortized. So again, it's a non-revolving line of credit during the project, and once it's done, it then amortizes out to and turns itself out. That's typically how all the loans work for a condo association.
So for a co-op, you maybe have a bit more, I want to say, luxury. I mean, you're basically a corporation sitting on their single tax lot, and you have the ability to refinance the mortgage that either the co-op has, or you're able to take on the mortgage on the property. So I mean, pretty much, I would say all of the co-ops we manage carry some sort of debt on the building, and when it's time to do the local law 11 or any sort of other major capital project, you look into your mortgage to see whether or not it makes sense for you to refinance, cash out on the mortgage, take on some additional debt, which you can amortize over whatever term of the mortgage you decide to go with. More often than not, our co-ops tend to go with a 10-year mortgage, because when you think about it, there's always a major project that, occurs every 10 to 5 years at a building. And it's really a cycle that coincides with when you're going to refinance that mortgage.
Got it. Thank you. Are there, certain types of loans that you don't recommend for a condo or a co-op in specific?
Hard money loan, which, interest rates would be 7 to 8%. And, the underwriting on those can be a week or two. You'll get the money right away, but.
Yeah.
And what about for buildings that don't have great reserves? Does that negatively affect their ability to get a loan?
Not necessarily. Good.
Oh, sorry. So really, when it comes to reserves, condo loans, what the collateral for your condo loans is essentially your common charges. So the bank, are they going to, look at, the financial standing of the building? Obviously. Are they going to, deny the loan because, you don't have 3 or 6 months of reserves, which is, the rule of thumb that, we tell our clients that that's what you should carry in your reserves, is 3 to 6 months of, your common charges. No, it shouldn't really be an issue with regards to applying for a loan.
Yeah.
Sorry.
Yeah, it might be for certain banks, because different banks have different criteria. They might have more of an appetite versus less an appetite. You'll see some banks, as far as the delinquencies for the building, delinquency ratios can vary from bank to bank. What's the number of renters in the building? So Again, it's it's why you want to get multiple bids. Some banks might have an issue with lack of reserves, while for other banks, it's not a problem. The most important thing is they want to see the financial strength of the building, the stability. Are they running any deficits over the last couple of years in their budget? How's the budget been handled over the last 2-3 years? The stability of the board. Has there been a lot of change to the board over the last 20 years or over the last 2-3 years, or has the board been pretty consistent? There is a lot of mitigating factors that banks can look into to offset the fact that there are little or no reserves.
It's interesting. Why would they look to a board's consistency, I guess, or players on the board as a level of
if the board's revolving door, then you see some inconsistencies or irregularities in the finances, and also just budgeting over the last over the most recent years. How has the budget been? Or are they staying on budget? So if there's a little bit of financial difficulties and a lot of changes on the board, it just raises it raises more questions, and it just makes the bank start scratching more and digging deeper into the loan.
Yeah, if there's more consistency on the board, it just shows stability, and
Exactly.
it makes the lender feel more comfortable. It paints a prettier picture. Like Reggie mentioned, another things that the banks scrutinize these days is really arrears. So you have to really stay on top of that. And if you do have an arrears situation, you have to be prepared to have an explanation as to why Miss Jones is, 60 or 120 days behind on her payments.
What about commercial vacancies? Because obviously that is a revenue stream that might be an issue.
Yeah, that's certainly an issue with the banks. If the condominium association owns the commercial unit and they expect some sort of revenue from it, the banks will take a look at that as well.
Yeah, I would imagine. So are you seeing a difficulty in getting banks to loan to buildings these days, or is it has been consistent with your years past?
From my current experience in past, it's been pretty consistent. There's been no real variances. They want to make the loans. Those that are in the market of lending to associations and buildings, condos and co-ops, they want to make the loans. Absolutely.
I agree. I mean, banks continue to lend the real estate. It's one of the safer investments that they can make. It's a very, very low loan to value.
Exactly. And when the loan is spread out between 200, 300 unit members, and there's delinquency ratio of 1-2% over the last 3-4 years, that's a pretty safe loan.
It's good. It's good to know, because I know this has been a time where a lot of people are looking at their home, their buildings, and they're saying, we need to improve upon this because I've now spent a lot more time here than I ever realized I would. As far as just COVID is concerned. So that's very helpful, I think, in just letting, our buildings know that money is available for improvements. All right, so let's discuss some insights and best practices, shall we? So, you all are experienced members in this field. What are some best practices and insights that you can share with our board members as far as, these are the things that we have seen that work, and maybe these are the things that we don't recommend?
I would say, the first thing that you should do, and Matt touched upon this already, if you're a condominium and, you're as a board, you're going to decide, yes, we're going to go out and get a loan. Even before you get this whole process started, contact your attorney, have them look into, the governing documents to make sure that the board is not required to have the unit owner's approval to even go out and obtain any sort of financing. In those cases, you do need 2/3 approval from the owner body in order to take on any sort of debt on the association.
I would recommend to the association, get yourself a good project manager. Interview 1 or 2 project managers, and that, I think, I stole your line right there. But yeah, get a good project manager to help you oversee. That makes the bank feel very good, especially if it's a project manager that they've worked with before in the past.
So what?
That would-
Yeah, I was gonna say, what were you gonna say? Sorry, Matt.
I would say I would totally agree with that. You know, just because we have these new local laws in the pipeline, you can't just really, as a board, sit there and it's like, all right, we got to go get financing, we got to go to get a loan, because you know the first question that any lender is going to ask you, and even if you were to go out and assess, you know, the owners, what's the money for exactly? So you really have to have your ducks in a row even before you go out and, you know, try to get the financing, whichever way it is that you're planning on doing so.
And Matt Resnick, what are your best practices that you recommend, or insights?
So, know what the worst case budget is number one. As been, said, know what's up ahead, and, try and start early. It can be 90, 120 days, be forthright with everyone involved, and, build a good project team from engineer, architect, designer on up. The better the team, typically the less unknowns, and when there's less unknowns, the more certain you can be about that financing that you do need. And also look at what government money's out there. There are great incentives right now for electric vehicle chargers are virtually free in New York City right now. New York State is providing great benefits to electrify as many items in your buildings as possible. Stay familiar with those trends, reduce costs, and try and even reduce the amount you need to obtain via those means.
And the lease, for me also, maybe last but not least, for the board, keep the building informed as much as possible. You can never over-inform and stay in communication, keep the lines of communication. It sounds a cliche, but as much transparency as possible with the bids, so that the board can feel comfortable, that the association feel comfortable that the board really did do their due diligence, and just again keep them apprised, and in the whole entire process. A lot of individuals, again, when they hear the building needs $3, $5, $8 million of renovations, they get overwhelmed by that number. Not realizing that it's evenly shared between all the association members, and then finding a duration loan that everybody is comfortable with. Just keep everybody involved.
So are there any tips that you have as far as loan duration is concerned that you can share?
Just just make sure it's a good, comfortable amount that everybody feels comfortable paying. I mean, you obviously don't want to go too long, but when it can be too short. And I've seen many instances where they try to be very aggressive, and it's to the demise of a lot of the board, and it just creates a lot of tension and friction. Just do the best to just find an agreeable term for everybody. And getting back to comparisons at the very beginning, making if there's not if the prepayment penalty is insignificant or minimal, like the bank will say, a lot of times the bank will say, there's no prepayment penalty if you come and refinance it with us. And if that's the case, if you want to pay it off early, there's no penalty. If the project is going better than anticipated, and it's not as expensive as anticipated, then you can pay it off early. So the duration isn't as long for those who do wish to pay it off sooner.
So it sounds like in certain cases it does make sense to prepay to deal with the prepayment penalty.
Yeah, absolutely. Yeah.
Yeah.
I'm sorry. Excuse me, Elise.
All right, continue. Yeah.
No, yeah, it's like, and if the prepayment penalty is oftentimes can be waived by the lending bank, as long as you as long as you pay it off with as long as I paid off with the funds from another institution, then it's then the prepayment penalty can be eliminated. And you can find a term that is suitable for the entire association.
Exactly. So you might want to take a longer term just because it's going to fit your budget better because the payments are obviously lower on the longer term. But in most cases, the lender will allow you to prepay the loan early as long as it's your own money. So if maybe you'll have a plan together that we'll do a 10-year loan, but we're going to plan to assess over 5 years, pay it off early. So we're going to save on a certain amount of interest that we would have paid if we went the full term.
And we're talking a lot about scenarios right now. When you're initially speaking with your broker or banker, ask to see different principal amounts with different loan term amounts. Play with it a little bit, and by doing that exercise, you'll know what's a good fit for your building.
Okay, does it make sense though? Because a lot of buildings are saying, I have to do a roof, but I also really want to improve my hallway, and I also want to do a lobby, and I got 4 different projects that I need financing on. How do you plan for multiple projects? Do you plan it to say I need a lump sum, or do you strategically plan, throughout several years?
So that's a great question. So the first thing we recommend is have a good capital assessment plan, and to get the plan, you need a good capital assessment study. You can either have an engineer or another qualified individual walk your entire building and inform you of what the useful life is of a certain piece of equipment, a hallway, a lobby, what the estimated age of that is, and when you can actually expect that to fail or become dilapidated or outdated even. And so with that information and a really good plan, then you can start working on the different loan types.
That's helpful. So it's not really like you wouldn't make the recommendation that you would do it all at once.
Mm-hmm. And I'd also say you don't just need one type of financing. You can do a partial assessment. You can try and get government grants. This new PACE program that the city is offering will actually allow you to finance your projects over real estate taxes at a very low rate. So, it's not, you can use multiple avenues to finance, your projects and needs. And note that there are sometimes specific loans types for specific projects. For example, there are organizations, NYSEG and the Green Bank, actually finance only green energy, greenhouse gas emission reducing projects. So there might be some other unique opportunities besides more traditional, lending opportunities.
Yeah, I was going to ask about, the Climate Mobilization Act, and I know we have an energy department with local laws now mandating that all the energy grades are on the buildings. How do you help our buildings, elevate their letters or at least be proactive and
Sure.
obtain financing for it?
So that's a great question. So, like everything else, know where you are today. So we have, AKAM has this data available. If you're bored and you want to know, is my building at risk of fines in 2025 or 2030? And if so, how much they are, please let us know. And with that information, we can help have an engineering study performed. And the best part about energy efficiency projects is the word efficiency. Anytime you make something more efficient, you're actually going to consume less energy. And when you consume less energy, you actually save on operating costs. So most, if not all of these projects have a return on investment within the useful life of that device.
That makes sense. Do you find that boards, because I've heard this, and I'm not a property manager, so, but I've heard boards speak about this, that sometimes it feels like there's a fear in getting financing, and it might be an easier route to go, do assessments. But I remember from being a broker back in the day, selling your apartment with ongoing assessments is always a big, that was the worst case scenario. So, what is your feeling on this as far as assessments versus financing? Are there fears to be associated with each?
I mean, if you're thinking about financing, the way a lot of boards look at it, and I tend to look at it that way as well. You're basically planning to stretch out an assessment because the loan has to be paid back one way or another. But maybe not all the unit owners are able to cough up $63,000 in a matter of 6 months or a year. But if you present this in a way, hey, we're going to finance this project and we're going to, structure the assessment over a period of 3 to 5 years, allowing, it's less of a blow on most unit owners, I would imagine. That's one way the board can take a look at it.
Yep, and it's a great point. And when you're taking money for projects, you're trying to improve. And so the whole point of whatever you want the money for is to improve the value of your homes, right? So you want balance. You don't want to have assessments going on for, in perpetuity. And you also don't want to take out so much money that you've increased your operating costs so much that your square footage to common charge is higher than, the neighborhood average. So it's really all about balance.
Yeah, that makes sense. And I think, now being on the other side of things, hearing the word assessment isn't as scary. I think if you understand where the money is going toward, and again, it's a limited time, as you just said. So, yeah. And then I think we're going to be opening up to Q&A. So I'll get started with a few of the questions that we actually have received already. So how do we assist co-ops in arranging new co-op mortgages?
So if you're a co-op and you're mortgage free, I would say kudos. Not a lot of those in our portfolio. I can think of maybe one or two. You're starting really with a clean slate. So it's like I said from the start, we have to know what's the money going for? What are you guys going to need it for? Because that's the first thing that the lender's going to ask for. And then, we can recommend, the type of lender you should go with based on, the size of the loan and the features that you're looking for. And we're certainly going to be there as your managing agent from start to finish to assist, with the underwriting, working with your attorneys and whoever else is involved in the loan process.
Right.
Yeah, just as what Matt just said is based on the scope of the project, we have a certain familiarity with the banks that like to lend to those particular projects. So, we tend to work with the banks that are more comfortable.
Yeah, can you maybe discuss some, as far as scope is concerned from a bank's perspective, if what might be something they lend more easily on, and maybe what they might be more hesitant, if there is that?
Really, I haven't really encountered it as a different. If it's for the overall beautification of the building and capital funds to just, as Matt just said, to just improve the building. As far as the work that needs to be done, I've not really encountered an issue with the bank. The sort of financial health and strength of the building. As far as it's just really the banks that are just most comfortable working with associations tend to just be the most flexible. Those are the ones that we're working with.
So
Okay. Yeah.
the one thing that I would add to that, no lender is going to want to see either a condo or a co-op take on any sort of debt to cover operating expenses. That's one thing that you really have to be aware of, because if you're taking on a loan to cover your operating expenses, guess what? It means you can't pay the loan back because you're short on the budget and there is no money to pay the debt service.
Yeah, that makes sense. What about so we've taken on some buildings that, are first time board because they're taking over from a sponsor board, and you would think it's already completed, it's new, but they actually need to complete capital improvement projects. Is that something, you mentioned being an established board, are those types of boards at a disadvantage, or are they able to also receive money?
There shouldn't be really a difference. The bank will, go through the same sort of underwriting process, whether, you're an established board or you're a brand new board that just, like you said, took on the property from the sponsor. So you're going to be going through the same sort of underwriting process, whether you're a 10-year-old building or a pre-work building.
Yes, that's actually a great point. Is there a difference that banks will look at so they don't care what the age is of a building for lending purposes?
They don't. It's really the same sort of criteria, the same sort of, underwriting you're going to go through. The banks engage third-party vendors to conduct their inspections, and they get the reports, and the credit committee makes their decisions based on those reports.
Got it. Thank you. What criteria should the building consider when they're trying to decide between an assessment and a loan?
So that's a great question. I'd say first I'd say the speed in which you need the funds and how much funds you need. For smaller amounts, we'd recommend an assessment. Something that you can do quickly. On a smaller level, that would be good. Sometimes you have a surprise that you weren't expecting, and you need funding quickly to take care of that repair. And then obviously market conditions. Are interest rates high? Are they low? Is this a good time to get financing? Is it a bad time to get financing? Do we want to assess now and with the, if market conditions are expecting rates to go down in the future, and to really take in all the factors. And really the speed, I would say speed might be number one. Like if you need money fast for something, you're going to more likely have to get, bank financing. But if something's coming up in 2 years and, it's not too significant amount of funds and you have a larger building in terms of units, you might want to choose an assessment.
Thank you.
Yeah, I totally agree with that. If it's a project down the road, you might, opt for assessment because you're not paying interest on money that you're assessing. But let's say it's a life safety issue comes up where, your building gets flagged during a facade inspection and you're mandated to do the work. The loan can get you the money 90 to 120 days and you're ready to start the work, and it's right there for you to use.
And one tool we use to help boards decide this is we model out your cash flow. When are you going to start a project? What are the expected costs? Here's what an assessment would look like, not only in terms of monthly revenue for the building, but how much would it actually cost unit owners? And is that more expensive or less expensive than an increase or to your operating costs and less common charges or maintenance? So I would model it out, review it too, and we can obviously help with that.
Great, thank you. How far out money-wise should capital projects or large projects be budgeted for in a co-op if the building doesn't or they can't take on a loan?
Well, we'd recommend that you have a good five-year plan minimum. 10 would be better, but 5 is good to understand what you could expect over the next 5 years. We're able to help with that. There are a lot of great engineering firms that'll do these studies, and with that, there typically aren't as many surprises. And when you're not surprised, you can make good better plans.
Great. All right, we'll have a few more. So do banks see a difference in needed projects like facade work versus wanted projects like hallways?
Do banks see any difference? I don't believe so, but I believe the DOB sees a lot of differences between the two. So you should obviously prioritize anything that has to do with, life safety code compliance. Those should always come first. And then, your list of additional things that you would want to do, whether, it's the hallway, it's the lobby, those should come second.
Got it. All right. And then I think we'll do the last question unless anyone else has additional questions. Of course, we welcome any questions that you might have at any point. Please feel free to email any one of us here and we'll give you all information after this. But so this person says they've heard some banks have their own engineers. Do they check on the projects?
Yes. So if you're a condominium association in particular, so the way the bank works, they'll hire their own engineer, and the bank's engineer will review the scope of the project, and then as you do the work, they will take a look at, the invoices that have to be paid, and the funds will be dispersed to you from the loan proceeds that you guys took on that closing.
Got it. All right. And I always like to end our presentations with questions and not questions, but your words of wisdom, because all of you have been in the industry for many years and you all have great advice. So if you can each just shed one piece of last bit of information as our boards go through a financing project, it would be great. So I guess I'll start with Reginald since he's at the top.
Start early, and the maintenance and the upkeep of the building is just an ongoing affair from really day one. Don't wait for anything. Just start early and stay on top. It should always just be a continuous discussion of what improvements need to be done in the building. I've seen just too many instances where too much has been kicked down the road, and then there's just way too much renovation and improvements that need to be done in the building, and you can't tackle it all at once.
Yes, that's very good advice. What about you, Matt Resnick?
So yeah, have a 5 to 10 year plan and model out the scenarios. Take your time, assuming you have time, understand what the building's needs are, and know how it's going to affect, your fellow shareholders and unit owners before making a decision.
Great. And Matt Cebula.
When it comes to the loan process, I would say transparency. You're obviously trying to paint as pretty of a picture to the bank that you're trying, or the lender that you're trying to work with, about the property. But if there are any major issues that you're aware of, whether it's arrears, it's some structural issues with the building, be upfront about it. Because if that stuff comes out in the loan process, you might be 60, 90 days down the road with the bank doing the underwriting. And once that thing comes up, when they do their own inspections, you basically just wasted time trying to apply for that loan, rather than being upfront about it and trying to show the bank how you plan on resolving those issues.
That's great. That's great. So it just sounds like you have to be proactive, not reactive, plan in advance, and then you'll be able to get the money you need to do the projects you need to do. That's all great advice. So thank you so much, Reginald, Matt, and Matt. We really appreciate your time tonight and your words of wisdom. And thank you all for joining us tonight. We hope that you'll join us again soon on our next roundtable. Thank you. Have a great night, everyone.